All right, the S&P 500 and the Nasdaq hitting fresh record highs. Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. We crossed 2,900 in the S&P. What's your year-end target?
Our year-end target remains at 3,000. I think we've got some more upside here. It wouldn't surprise me if we got a little bit above that, but let's not get greedy just yet.
I guess what brings us to that level of 3,000, and is it kind of this granular move over the next couple of months, or do we see some sort of pullback and then kind of rally back to that relatively high level?
I think we keep grinding higher, and I think what's driving that is a lot of the worries, a lot of the bad news that the market has kind of been digesting has starting to go away. We saw a deal with Mexico. That was helpful. We see a deal with Canada. That would be helpful. And if we get some good news from China, I think we're just going to keep trending up.
So you don't see any type of pullback triggered by perhaps the midterm elections or the historical choppiness that we tend to see in September and October?
Choppiness, I think, is quite possible. The midterms, I don't think so. And the reason I say that is right now the expectation the Democrats are going to take the House. So I think the market recognizes that as a possibility. I'd be surprised if there was a big reaction.
The Nasdaq also crossed 8,000 for the first time ever. We're getting help again from FANG. Is that trade back on in your view?
I think it is back on. I think the market had a chance to really reevaluate what was going on. You see what happened with Facebook. You see what happened with Twitter. But the market seems to have bought into, yes, growth is the place to be. Unless something changes, and I think there's nothing on the horizon that would suggest it might in the short term, we do see them continuing to rise.
Although President Trump, of course, is tweeting again about the stock market records, but he has also tweeted criticisms of Google News, of course, of Alphabet, saying that they're suppressing conservative voices. Should investors be worried about tech regulation? Is that something they're overlooking right now?
I don't think so. Certainly not in the short term and probably not in the medium term. A lot would have to happen before we got anything in the terms of legislation through the Congress. So I think at this point, it's not that significant.
But maybe it causes investors to be a little bit more selective about what tech stocks they're buying. Maybe it's better to go into some of the semi names or the cloud names where you're still getting that growth, but you're a little bit more immune to the whims of regulation in that sense?
I think there's a lot of arguments to specialize in what you're investing in, but every single area of the tech sector has its concerns. The FANG stocks, regulation is one of them. The semiconductor firms, they're doing very well. But again, a lot of that is driven by trade concerns. What happens if we actually start to get deals in place? There's risks at pretty much anywhere you look at current valuations.
In terms of earnings, we've been getting, strong retail performance from, places like Tiffany. We saw 8% comps. I guess, what do comps like that in a luxury outlet say about the consumer?
The consumer is confident overall. I mean, we're seeing spending go up pretty much across the board. But the people who have the most money to spend are going to be spending the most. And the same confidence that's driving up the stock market can also drive luxury spending. And I think that's actually a sign that that confidence is much more widely spread than just the stock market.
So if you're looking in the retail sector, maybe it's better to be in some of the more luxury sort of avenues of that sector than the discount space. Is that a theme that you would advise investors looking into?
I've been like consumer discretionary for a long time because people have the money to spend. And of course, it's when you rob, why do you rob rich people? Because that's where the money is. And I think as an investor, you have to look for the same thing. And that certainly points to the wealthiest are getting the most bang for the buck from the tax cuts. They're getting most in terms of income and net worth appreciation. They can spend and they're willing to. So it only makes sense to focus there.
Aside from consumer discretionary, are there other sectors that you are bullish on for the remainder of 2018?
I think it's time to start looking at some of the more defensive sectors. I think it's time to start looking at real estate, for example. That's had a bit of a run recently. And that's an area where you're going to not only participate in the economic growth, but you're also going to have a defensive position against rising inflation. Again, we're not there yet, but we can see signs of it. So even as things continue to get better, I think it's time to start thinking about what comes next. And that means starting to move into sectors such as real estate.
All right, so if you're thinking about getting defensive now, does that suggest that you're worried about stocks in 2019? Because there are worries about earnings growth in 2019.
I'm far more worried about a recession than I am about earnings growth. This market has shown a real ability to take bad news in its stride, and a slowdown in earnings growth, as long as it was still reasonably healthy, which looks likely, is something I think it could overcome. But historically, when we've seen real pullbacks, it's come in the context of a recession. And that's something that is very possible for 2019. And that would be where I would start to worry.
And what would a modern day recession look like, say, in 2019? Because when we hear recession, it's natural to go back and think of 2008.
2008 was not a recession. 2008 was a depression. 2000 was a recession. We see growth go a little bit negative for a couple of quarters. That's a technical definition of a recession. We don't have a lot of the imbalances from an economic standpoint that we had in 2008. So when I say a recession, I'm deliberately not talking about 2008. But the thing is, with stocks as highly valued as they are right now, 2000 is actually a very reasonable comparison in the financial markets as well as the economy. And that's where I think we should be looking for lessons from history.
All right, so let's say we do end the year at 3,000 in the S&P 500 and we see some sort of recession in, call it mid-2019. Maybe it's caused by Fed tightening or, this inverted yield curve worry. I guess what is the market reaction to that? How much of a pullback could a recession spark?
I think a bear market is quite reasonable in that context. Certainly not guaranteed. I don't want to spook anybody. But if you look at what a bear market would mean, by definition, it's about 20%. So for the S&P, from 3,000 to 2,400 would make a lot of sense. Again, this is not a prediction. It depends on what the economy does. But I think that's a reasonable target once you start talking about downside.
All right, Brad McMillan, we'll continue to follow all the market action this week. Thank you very much for joining us.
Thank you, Scott.